So I think there's real risk on this one. Institutional investors, by the way, have a lot of thoughts on what's happening here, as you might imagine. And I think there's a lot of skepticism broadly among institutional investors. Is this a way for asset managers to simply just gather up as much capital as they can and have a lot less care in terms of what type of investments get populated into these wealth retail-oriented products? And I think that there is absolutely going to be slippage, right?
Hi, this is Matt Palker with Wendy Lee. We're co-founders of Ivy Invest, and welcome to the Investment Office. Every week on the Investment Office, we cover the latest in capital markets, alternatives, and retail investing. This week, we're going to be discussing one of the most significant shifts we've seen in retail investing, which is the big new focus from alternative asset managers on individual high net worth investors. These are firms that, until just a few years ago, really only focused on, Wendy, the kinds of endowments and foundations they used to work at.
That's right. A lot of these alternative asset management firms have historically offered large institutional products to large institutional investors, and there has been an increasing interest in bringing those products and those strategies and packaging them in ways that are suitable for a different audience, in this case, what is known as the wealth channel.
What do you think is causing this shift?
Well, I think there's multiple dynamics, but if we can just sort of cut to the core of it, I think a big part of it is these large managers are looking for ways to grow their asset base. It helps them to be able to diversify their existing investor base. And so one of the things from a business standpoint, from a resilience and stability of business standpoint, is to be able to have a broad and diverse set of investors from whom you are receiving capital. And so these large asset managers have looked at the wealth capital as both a source, a diversifying source of capital for their own businesses and their own investment strategies, as well as there's the other piece of it, which is large institutional investors who have been the bulk of their longtime investor base. A lot of large institutional investors are, given some of the factors that we've talked about previously, are at or near their capacity to continue investing or increasing investments into these asset managers. And in some cases, these large institutional investors who may be over allocated to the types of private market strategies in which these asset managers deploy capital and may need to, if, in many cases, actually reduce their future investments. And so from, again, an ongoing business standpoint, resilience standpoint, where is that next incremental investment dollar going to come from standpoint, these asset managers are looking out and seeing, and I think appreciating for the first time, that there are a lot of dollars held by individual investors in, again, in aggregate, what's known as the wealth channel, which is predominantly investors who are investing and being guided by financial advisors, whether those are independent financial advisors or financial advisors as part of broker-dealers or wirehouses. And then the part of the individual investor universe that is not really seeing as much attention at the moment, but is sort of comparable, are those individual investors who just, for whatever reason, don't happen to work with a financial advisor. The focus for a lot of these large asset management firms right now, for I think some really understandable reasons, is on those individual investors who are working with financial advisors, as there are some pretty well-established existing ways to reach those investors.
So in some sense, I guess they've kind of overfished the existing ponds, and they're looking over and saying, "Wow, there's a pond with some the fish. The individual fish might not be quite as big, but there's a lot of them."
Sure, that is an analogy that you can use.
Maybe not orcas, but there's a lot of goldfish there. Um, but what's interesting is is this shift is producing dividends for these funds, right? You look at Apollo now is raising over $1 billion a month from the wealth channels. KKR has raised, I think, $12 billion across their evergreen wealth strategies. You look at Cliffwater, who was one of the earliest to build private credit strategies for this channel. They've got 31 billion, more than 31 billion in their
I
direct
can't
lending
believe
fund.
that. That's insane. Like that, I hear you say that, and that just is wild to me because the Cliffwater that I had known for a long time, they were well known for being an investment consultant to institutional investment managers. And you're absolutely right. They have been a fascinating case study in what I'll call both their creative ability to package their expertise into an investment product and to do so with an investment structure that called an interval fund, which obviously we're quite familiar with given that our own fund is also an interval fund structure. The interval fund structure that they chose was not a particularly widely used structure at the time that they packaged their strategy into this vehicle. And then they went and they have become this phenomenally successful asset manager, which is not who historically they have been. So when you say that, I'm blown away because I didn't even realize that that is how large that strategy has grown into. It's a fairly new strategy. It's a fairly new product. It speaks to the demand that they have seen in the market for what they were offering. And this is something that you and I have talked about, which is I'm not sure that broadly speaking, everyone is aware of just how strong the demand is for a greater variety of investment strategies and products that are institutional in quality. Again, they started at $0 and now it's $31 billion and over a fairly short time frame. I'm I'm still stunned.
Yeah, I mean the fund is just over 5 years old, or 6 years old, I think, at this point, rather. And so, it's a new strategy. Getting there in that amount of time is really remarkable. And I think, to your point around the demand, I think it really speaks to the fact that, you just how much money there is in, as you said, kind of broadly the retail wealth channels, and how underpenetrated what most folks would call alternative investing is, right? You look at most of the stats will say that, the average, even high net worth individual, their alternatives exposure might be 1 or 2% of their portfolio.
It's not surprising to hear that because there's two primary reasons that I would point to. One is these large asset managers, as I had referenced earlier, had really built their businesses partnering with institutional investors and catering to institutional investors. And that was really the core of their focus, both from a who do we approach to seek capital from in order to execute the strategies, and then who do we continue to engage in dialogue and continue to get to know and network with. And so I think for so long, individual investors just were not an area of focus for these asset managers. And so it's not surprising they weren't being marketed to. They weren't necessarily being spoken to. And so it's unsurprising that individual investors don't have more exposure to these types of alternative investment strategies run by these asset managers. And the second piece of it, I think, is also the individual investors have there's limited information out there. This is something that we talk about a lot, which is institutional investors, there is really depth and breadth of expertise that is not broadly shared. It is often internally kept at the institutions in which that expertise and knowledge is gained and that data set is accumulated. And at most, it is cross shared with other institutional investors. It's not as though there's a huge amount of information out there for individuals to understand what are the different types of alternative investment strategies across private markets, whether that is equity markets, credit markets, real assets. There's all of these types of considerations for each of these strategies, these alternative investment strategies, that if you were to evaluate an investment manager or an investment strategy and you wanted to do investment due diligence, what does that template look like? What does that investment approach and a process look like? It's not out there because institutional investors aren't rushing to put that information out there. And if those are the folks who've been investing in that way and that information is again kept internally, it's again not surprising that individual investors who would have to dig pretty hard or have to know somebody who is in the professional investment universe there would have to be some level of connectivity or ability to dig into it in order for them to even feel comfortable to invest into these alternative investment strategies. And so there's just this, I would call it a gap in information availability out there too that speaks to it's not surprising that individuals don't have a larger portion of their net worth or investable capital in these less well-known alternative investment strategies.
Well, and I think that speaks to some of the potential risks here with this new push that I want to come back to in a little bit. Before we get there, actually, one of the things that has really enabled this new push, I think, is the availability and you touched on this, of new product innovation on the parts of the funds, because these funds that are being made available to retail investors, they often don't look like the kinds of funds structurally that you used to invest in when you were at your endowments and foundations. And maybe we could touch a little bit on that product innovation.
Yeah, so a big part of it is fascinating and it makes sense when you think about it, but structure really matters in terms of who the end investor is. The traditional structures that institutional investors have invested in many of these alternative private market investments. The traditional structure is what is known as a drawdown structure. It is a private vehicle. It has a few parts to it, one of which is there is an investment amount that the institutional investor, will determine that they would like to invest into the asset manager, into the GP. So the limited partner, that institutional investor, the LP, might say $10 million is what I want to invest, but they don't deploy that capital day one in this drawdown structure. It is invested in what's known as a commitment. So they're saying at some point over the life of this investment, this drawdown structure, the LP is going to invest up to $10 million. And so what happens is that these structures, these drawdown structures, they have what's known as terms. They have limited lives. So there's an investment term, typically let's call it 5 years. There is then after the investment term concludes, there's what's known as sort of a harvest period, which continues for up to 10 years after the initial start of the fund. And so what you end up having is this dynamic where the GP will reach out to the LP and say, hey, remember that $10 million commitment that you made? I'm issuing what's known as a capital call, and I'm going to call some amount of that investment. It could be $1 million, it could be 2, it could be 3, it could be sometimes even larger, and I'm going to need you to wire those dollars to me in the next 7, 10, 14 days, whatever that initial time frame is that they've been given to fund that commitment. And so you have this structure and this mechanic, just the mechanics of this investment structure are less familiar to an individual who has not engaged in these drawdown structures before. For institutional investors who've been investing in this way in these structures for decades, it's, oh, okay, well, we've made a commitment. We know to expect capital calls on this commitment. We are keeping track of what our unfunded commitments are. We are tracking our investments and modeling out what our commitment pacing will look like and what our capital call pacing will look like, what our expected distributions will look like, what our overall investments in these asset classes will look like over time as our NAV builds. And so for an individual investor, again, the mechanics of it are challenging. Remembering to keep track of when you invested, oh, by the way, it didn't draw down day one. So what do you do with that? How do you mentally account for these investments that you know you have to fund at some point, unknown time period in the future? And again, that mechanical structure of the drawdown funds, it's familiar to institutions, not familiar to individuals. It is a pretty tall order to ask individual investors to say, okay, if you want to invest into private markets, you now need to be able to comfortably learn how to manage your capital to meet the needs and pacing of these drawdown structures, right? And so I think for a lot of individual investors, and also for GPs, it can result in frustration if individual investors are not as familiar with the capital call structure. If for whatever reason there's a missed capital call, it is actually a really serious thing. Like it's very, very serious to default on your commitment as an LP. In the legal documents, which are 100-page documents for these types of investments. These legal documents effectively say if you become, for some reason, a defaulting LP, if you fail to make the capital calls and you have previously invested some amount, but then you sort of forgot to keep track and didn't keep enough capital liquid to be able to fund future capital calls, defaulting LPs are liable to lose their entire investment. There's not necessarily going to be compensation for what you've already invested, right? Like it is actually a fairly rigid investment structure that is meant to protect both the LP and the GP. I won't delve into any more of the specifics of it because I feel like I've sort of already gotten into the weeds a little bit here. But ultimately, the point is that this is a challenging and unfamiliar structure for individual investors, again, just mechanically speaking. And the other piece of it is actually from a tax document standpoint. What you end up receiving is what's known as a K1 for these drawdown structures, which if anybody has received a K1, it is a giant pain because you end up often having to file tax extensions. And each year I'm waiting for those K1s to come in at some point before October 15th. And so it becomes, again, for an individual investor who's not familiar and hasn't already accounted for these inconveniences in both their investments, in their, the amount of dollars they keep liquid, in their tax planning, it is just a really high bar, a really big ask. And so for alternative asset managers who are interested in finding ways to reach out to individual investors through these wealth channels, if they want to see success, it is at this point almost a requirement for those alternative asset managers to think really carefully about the structure that they're going to offer to those individual investors. And so what you've seen, really long-winded way of coming back to your original question, what you have seen is that these asset managers have grown to adopt what are known as these evergreen structures that are called typically interval funds or tender offer funds. And these evergreen structures have some key advantages for individual investors, not least of which is it is, as the name connotes, it's evergreen, meaning that it's meant to be a perpetual investment vehicle, investment fund. And individual investors who wish to deploy, let's call it $1 million into that investment fund, will day one fund that $1 million and immediately receive a $1 million investment into that fund. It's not something that's going to be out there as a uncalled commitment to be required of them at some point down the road. It's very familiar to individual investors. It is you request to make an investment, that investment is accepted, and then you fund it. And that's it. So there's that piece of it where it's purchasing shares of a fund, and it is very normal and natural, I think, to individuals. The second piece of it is that these funds are 40 Act funds. They are governed under the 1940 Act, which is also what the SEC uses to govern mutual funds and ETFs. And so it is pretty standardized in terms of reporting and all of the regulatory requirements. It is definitely much more onerous than running a private fund. But the flip side of that is it creates, again, a standardized and more familiar experience for that end investor, for that individual investor. And then the final piece is going back to that tax piece. These evergreen structures, these 1940 Act evergreen structures that are tender offer or interval fund, because they are 1940 Act funds, they issue 1099 divs. Very familiar to individual investor, similar to what you might get from mutual funds or your brokerage accounts, right? And so it creates this experience that is very familiar. And because it's familiar to individual investors, all of a sudden, what you're seeing is that there is just much broader uptake, right? And so one of the things that I appreciate so much more in having experienced this endeavor, this building Ivy Invest together here, is I have such a greater appreciation for the creativity and innovation that I'm seeing out there among asset managers and the ways that they are figuring out how to package their existing institutional investment strategies that were previously really focused on institutional investors as their underlying investors, figuring out how to package those strategies into vehicles and structures that make sense for individual investors. And that it does take creativity for some of these asset managers and some of these strategies.
And one of the things that makes me think of, going back to the risks, the kind of question around risks here is, uh, are there people being maybe overly creative and putting strategies that perhaps should not go in these kinds of structures? I think about the world that I come from, which is venture, and having sat on the GP side of a venture fund, where that traditional kind of drawdown structure that you referred to is kind of conceptually a great fit for how you think about venture investing, right? Which is you invest early, or you invest certainly at some point in the life of a startup, and that might be very early if you're a seed fund. It might be somewhat later stage if you're more of a later stage venture fund. But ultimately, the returns for those venture investments tend to be much later. If it's a seed fund, it might be a decade later. If it's a later stage fund, it might be 3 or 5 years later. But there is some lag, certainly, between when the investment is made up front and when the returns are seen, uh, that feels like a good fit for that kind of drawdown structure that you described. And so I wonder if there are certain kinds of strategies like venture that maybe shouldn't go in some of these, or are at least less of a good fit for some of these evergreen structures.
So back to one of the things I mentioned about these evergreen structures, particularly the ones that are SEC registered, 40 Act funds, because of the standardization piece that I talked about, there are certain standardized liquidity requirements for these structures, particularly interval funds. Tender offer funds can have a little more wiggle room. But the interval fund structure typically requires that as the investment manager, they offer periodic windows of liquidity for their investors. And these periodic windows of liquidity typically are quarterly. And so what that means is that in any given quarter, again, going back to a structure that brings a level of familiarity to that individual investor, one of the things that individual investors are familiar with is the ability to redeem their capital, the ability to have liquidity at regular intervals. If you're typically familiar only with mutual funds or ETFs or have been investing in individual stocks, then liquidity is a daily occurrence in these types of investments. Interval funds have liquidity, like I mentioned, typically at quarterly periods, which not daily, but again, not so wholly unfamiliar. And so versus the drawdown structures that I had mentioned earlier, liquidity from those structures is completely unpredictable. It can be many, many years after investment, and you typically one day receive a notice from your GP that says, by the way, we have sold this investment. We are going to make a distribution in X amount in a week's time. Please confirm your wire instructions. It's a great day, but you don't know when that day is going to come, right? And so the nice thing about these evergreen structures is there's some predictable cadence to when an investor would be able to request their capital back. And because of that, because they are required based on their documents and based on the liquidity that they have stated, these interval funds on a quarterly basis need to be able to figure out where that liquidity is going to come from in their portfolio in order to give it back to their investors who ask for it. Investment strategies that have truly require long lockup periods of investment and do not have necessarily over the course of that investment a reliable way to generate liquidity. Early stage venture is a really great example of that. There is a real mismatch in terms of the liquidity that is required based on the structure they've chosen and the underlying liquidity of those investments. That's, I think, a big part of why you have seen private credit strategies be a really, really successful strategy that has been packaged in these evergreen structures. Private credit has periodic liquidity from the investments, the underlying investments, whether it is contractual payments, interest payments being made from the underlying loans, whether it is loans coming to maturity. And so that liquidity, again, is much more frequent and predictable. And an investment manager can line that up in terms of lining up the liquidity that they know is coming from their underlying investments with the liquidity they know they'll need to offer to their investors from that structure. And so it is unsurprising that that has become one part of the market, the private credit market, that has seen enormous success in offering these evergreen structures and seeing investor uptake. I think we're not seeing a lot of folks offer interval funds based on early stage venture strategies and the like because it would be unwise. I'll put it that way, unwise to do so. And so there are, again, these structures. You can be really creative. You can, as an asset manager, find a way to put a lot of different strategies into these evergreen structures that are and are more amenable to individual investors. But these structures are different, right? There are different trade-offs that occur when when it's not a locked up pool of capital, where as an investment manager, you do have to manage and plan for periodic windows of liquidity. It makes it such that not all strategies will make sense. Some strategies really do depend on that fully locked up nature and dependability of that locked up capital. And so not everything will fit.
And so as I think about the risks, that's clearly one risk that I think of is, is the strategy being offered? Does it make sense in the structure being offered? The other, just as an individual investor, the other risk that comes to my mind is a risk that I always ask whenever somebody brings me a investment opportunity, which is, why am I being shown this opportunity? Right? Like, why is this even an option for me? Given that historically, to your point, the uh, biggest source of capital for premier funds, for premier asset managers, were large endowments and foundations because of the scale of capital and sophistication. And so it strikes me that perhaps one other risk for a retail investor in this new world is, are retail investors serving as a dumping ground for the less good ideas, the less good investments that some asset managers may have?
So I think there's real risk on this one. I think this is something that where I have seen a lot of pushback from institutional investors, by the way, have a lot of thoughts on what's happening here, as you might imagine. And I think there's a lot of skepticism broadly among institutional investors because there is this perception that is this a way for asset managers to simply just gather up as much capital as they can and have a lot less care in terms of what type of investments get populated into these wealth retail oriented products? And I think that there is absolutely going to be slippage, right? I think the best way to think about it is that, and this is the way I typically frame things when I'm looking at investments, is that there's a cost of capital associated with any type of investment strategy, meaning that an investment has to meet what is this minimum cost of capital hurdle to make sense for that end investor. So, what I mean by that is when an institutional investor is investing in, let's call it private equity, in one of these traditional drawdown structures, that institutional investor is expecting a certain return from that investment in order for that investment to earn a place in the portfolio. Let's just hypothetically say the expectation is that investment is going to return 15 to 20% over time. And if it does not meet that cost of capital, it is not going to earn a place in the portfolio. I would argue 15 is actually quite low and probably would, if if a private equity firm were offering only 15%, would probably not make the cut. And so this is all a part of the underwriting process, right? You don't necessarily know going in exactly what return you're going to receive. Everybody goes in with the same level of expectation that if we agree that the manager's strategy and and the strategy on which they're executing has the ability to generate, again, that 15-20%, and we believe it, and we believe they can do it consistently, then we might say, okay, then it meets the cost of capital for an investment in the private equity portfolio. That's the traditional drawdown structure that I'm, obviously very familiar with and I know well. And so I know what types of investments are going into that structure. Where it gets a little tricky is if the cost of capital for these evergreen structures is lower. Let's say the investor base is being told that the investments are targeting, let's call it a 10% return, and it's still considered a private equity strategy. Well, all of a sudden, that's a very different cost of capital for the asset manager. In order for them to make an investment that is worthwhile for their drawdown structures, they know that that investment that they make has to, in their underwriting, be able to deliver ultimately 15 to 20% net for the institutional investors in that drawdown structure. But if they know that they have a different pocket of capital, an evergreen structure, let's say, and for whatever reason, that evergreen structure has a lower cost of capital because those investors are not requiring a higher return than, let's say, in this instance, I use 10% as an example. Then all of a sudden, it's a different set of investments that might be able to generate 10%, maybe couldn't generate that 15 to 20. And so all of a sudden, it's a different investment that they would never make in that drawdown structure that maybe they'll put into this evergreen structure, right? And so I think of that as being one example, and I think there are others, but that's certainly one example of where you can see there potentially being different types of investments being offered to institutional investors and to the individual investor. And that's something that obviously, again, having lived my career as an institutional investor, I'm very keenly aware of. And that is, for me, something that is a big consideration, right? As we think about the type of investments that we make. And so I am not entirely certain, and this is where I think some of the challenge is going to lie and continue to exist for some period of time. I don't know how an individual investor who has not sat in a seat like mine for as long as I have would know whether what's going into the evergreen structure is the same as what goes into the institutional investment structures. Like, I have a lot of ways to back channel there. Like, there's a lot of ways for me to know and for me to have confidence in looking for things that are pari passu. But if an individual investor doesn't have that visibility into what's happening on the institutional side of the book, then that individual investor might not realize they're being offered something different than what's being offered to institutional investors. And it doesn't necessarily mean that this is in bad faith, right? Because from a manager's perspective, they may say that we made it very clear what the return targets are for this, more retail-oriented strategy. And so from that perspective, they're not necessarily operating in bad faith. It's a difficult thing to parse out, especially if as an individual investor, you're coming into this for the first time, right? And there's just a lot of nuances, I think, that will continue to be fleshed out. And there's certainly going to be, I think, lessons learned. And I think there are going to be perhaps, some experiences that are less than positive along the way for investors as everybody tries to figure this out. There's going to be a learning curve for everybody, individual investors and alternative asset managers. So I think the landscape is evolving, and I think it is going to come most likely with some growing pains for everybody.
And I think we'll leave it there. Lots to see over the next coming months and years around how these asset managers continue to push both into the financial advisor channels, but also beyond. Thanks for joining us this week on the Investment Office. We'll see you next week.